We need to pick up with bad debt expense. Just to recap, that the entry to record bad debt expense is an adjusting entry is to debit the bad debt expense and credit the allowance for doubtful accounts. The entry reduces income, reduces the assets, because the allowance for doubtful accounts is a contra asset account. Just recapping here, we have accounts receivable $35,000, the allowance for doubtful accounts of $4,200. That leaves a net realizable value of $30,800. So that is what the company realistically expects to collect from the credit customers. Now, the bad debt for book purposes can be estimated in either of two ways: a percentage of credit sales, which is the easier of the two methods, or as a percentage of accounts receivable, which is also referred to as aging the receivables. This one is actually preferred, gives us probably a better measurement of what is uncollectible. Let's go through and take a look at the very first method, the percentage of credit sales. So the firm estimates the percentage of credit sales it will not collect, and each year takes that amount as bad debt expense. So we've got Driscoll Company estimates that each year 2% of its credit sales will be uncollectible. Credit sales for 2008 are $200,000. So you take the $200,000 in credit sales. This does not include cash sales, just credit sales, times 2%, and there's $4,000. Now, a business can come up with that 2% of credit sales, or whatever the percentage is, by taking a look at the previous year or previous years. It may be an average of the previous 3, 4, 5 years. If the business is brand new, they can take a look at some industry information that they can gain as to what competitors are doing. We're going to take the adjusting entry then, that $4,000, debit it to the bad debt expense, and credit it to the allowance for doubtful accounts. Now, with the percentage of credit sales, keep in mind that we're ignoring what the balance in allowance for doubtful accounts is. That's irrelevant to the adjusting entry. We just simply take the $4,000, use it. Now, percentage of accounts receivable that we're going to estimate to be uncollectible, we are going to need to take into consideration the balance at year end in the allowance account. Potage's AR, accounts receivable, has a year-end balance of $20,000. It estimates that 3% of this amount will be uncollectible. So the allowance for doubtful accounts currently has a $400 credit balance. All right, what we want to do is take that 3% times the $20,000 accounts receivable balance, and that's saying that $600 of the total $20,000 is deemed to be uncollectible or will be uncollectible. We don't know who yet, which customers. We just have a dollar amount. Now, there's already a $400 credit balance in there. Well, we want the ending balance to be $600. So we're going to need to take, and this is back our way into the dollar amount for the adjusting entry. That $600 we want to have as a credit balance. There's $400 as a current credit balance. So what do we need to do to get it to go from $400 to $600? Well, we need $200 in this case as the adjustment. That means we're going to need to debit bad debt expense for $200 and credit the allowance for doubtful accounts for the $200. So, as a percentage of accounts receivable estimated to be uncollectible, we're going to take the balance in the allowance account and we need to adjust it to reflect the percentage of accounts receivable estimated to be uncollectible. So, to give an illustration there. Here we've got Storco's accounts receivable currently has a balance of $50,000. Its allowance account has a $3,000 debit balance. Storco estimates that 5% of accounts receivable will be uncollectible. That's pretty high. We'd like to see that figure be lower percentage-wise, 2%, 1%. 1/2 of 1% would be even better. I'm a realist, and I know that whenever we sell on credit to customers, we're not going to collect 100%. Alright, we've got our allowance for doubtful accounts. In this case, we're taking the $50,000 times 5%, and the required balance at the end of the fiscal year is $2,500. There's a beginning balance there of $3,000, a current balance, I should say. So how do we get from a debit balance of $3,000 to a credit of $2,500? We're going to have to take and add the two. So $5,500 credit will net a $2,500 ending balance. So with the basing it on the receivables, we need to use the balance figure and work our way backwards. So we'll need to debit bad debt expense, credit the allowance for doubtful accounts in this particular situation for $5,500. Alright, Storco's accounts receivable currently has that balance of $50,000. Oh, it's the same story. Once a customer's account is deemed uncollectible, it is taken off the books. So we have a write-off. We have identified who the customer is. We're going to debit allowance for doubtful accounts for that amount of that customer and credit the specific accounts receivable account. This effect has no effect on total assets. It reduces accounts receivable, but at the same time we're reducing the allowance account by the same amount. So the net effect on assets is 0. Alright, tips on adjusting journal entries. Every adjusting journal entry must include at least one income statement account. That means it has to either involve a revenue or an expense, and it has to involve one balance sheet account, either an asset or a liability. So one income statement account, one balance sheet account, always, 100% of the time. Therefore, if you omit, if you fail to record an adjusting entry, net income is going to be misstated. It will either be overstated or understated. Cash is never involved in an adjusting entry. Alright, let's take a look at the chart of accounts. Companies that generally have GL, general ledger account numbers, assets are in the 100 range, liabilities 200, owner's equity 300, revenue 400, expense 500. And we're seeing accounts numbered with 3 digits. They could be 4 or 5. Could even involve a number, hyphen, another number. There are different variations, but here's the basic that we need to be familiar with. Normal balances, that all accounts have a normal balance. For example, accounts receivable has a normal debit balance. And the normal balance is the side, the debit or credit, on which the increase is recorded. These are just basic review tips. Alright, increasing cash, you debit it. Cash has a debit balance. Increasing revenue, you credit it. Revenue has a credit balance. Here we've got a chart that is just reiterating what are the normal balances. So just refresh your memory on that. I'm assuming that that's pretty current. You would have covered that in practical accounting, high school accounting, accounting 1, accounting 2, and so on. Here's a normal balances exercise where they're just going to go through and you can play this through as far as this is giving you a typical listing of accounts and what the normal balance for those accounts are. They're not sorted by assets, liabilities, they're just in various random order. We have a worksheet. Just recapping, the worksheet was covered again in a previous class. We start with the unadjusted trial balance, and under accounts you would list each account title I prefer to list them in the order of assets, liabilities, owner's equity, revenue, expenses, and you would enter the dollar amount of the balance under the appropriate column, DR for debit or CR for credit. We then have another pair of columns for adjustments, that those adjusting entries that we've just looked at, whether they're an accrual, deferral, or other adjustment, would be listed. Again, the amount as debit or credit. We then come to a third pair of columns, the adjusted trial balance, and that's where we update the balance. You start with the trial balance, either add or subtract for adjustments, and then have our adjusted trial balance figure. Here is a worksheet, an example for Funky Time for the year ended July 31st of 2009. You've got all the accounts listed in order, again, assets, liabilities, owner's equity, revenue, and expenses. And you've got the normal balances, and they should be added in the trial balance. They total $41,500 each, double rule. That's the first step. Now, we're looking at the adjustments, the supplies expense. If you look up at supplies, it has $2,000, but they're saying supplies expense must be adjusted to show that only $400 worth of supplies are on hand at year end. So if we started with $2,000 but now only have $400, that means $1,600 has been used. So we credit supplies, debit supplies expense, and that is a minus up there. So supplies will then have in the adjusted trial balance $400, and we will find that over in the adjusted trial balance, the supplies expense $800 plus $1,600 add up to $2,400. The 12-month insurance policy was purchased on June 1st, and so that's $400 that is being subtracted. So that's $2,000 then in prepaid insurance that's remains, and that's $840 in insurance expense. So when all the adjustments are entered, the new balances are then, you go from the adjustments, you update, you have your adjusted trial balance. Each pair of columns needs to be added. They need to match. When they match, you double rule. All right, from the adjusted trial balance now, we're going to take the assets, liabilities, owner's equity, and we're going to have to move those to the balance sheet, and the revenue and the expenses are going to be extended to the income statement columns. So that's what we're going to do. If I was using an Excel spreadsheet, it would be like a copy and paste. They're already clustered together. When you add the columns, you will notice at the bottom that the pair of income statement columns do not balance, neither do the balance sheet pair. You find the difference. The difference will either be net income or net loss. So as we look at this, they're going to fill this in. The difference on the income statement, the credit of $15,420, which is the revenue, and the expenses of $11,574. You find the difference that when revenue is greater than expenses, you come up with net income. And you'll find that on the balance sheet, we're going to have to add that same $3,845 to the credit side, because that adds to the owner's equity side. And then we'll have each pair of columns for income statement, balance sheet, as well as the previous sets, are all in proof, in balance. And we're great.